Welcome back to Middle School Money Matters. In the last video, we talked about the history of banking in Canada and just touched on the types of accounts that Canadian banks offer. In this video, we're going to go into those accounts in a little more detail and see what we can learn. Now I realize that this topic might be a little dry and boring for you, so periodically during this video, I'm going to crash some symbols together to make sure that you're still awake. It might look like this.
Wake up!
All right, let's get started.
As mentioned, banks were really born out of a need for credit, but initially the capital that the banks had to lend out was provided by wealthy businessmen and merchants. It wasn't until later, when the public trust in the banking institutions really increased, that a lot more people started putting their money into the banks and, in exchange, earning a little interest. Nowadays, it's almost impossible to live comfortably in Canada without a bank account. So many of our modern conveniences are tied to our banking. Most employers now require a bank account so that employees can be paid through direct deposit. It's much easier to deal with the Canadian government and the Canada Revenue Agency if you have a bank account. And also, it's nearly impossible to purchase anything online if you don't have a credit card that is generally tied to a bank account. While most businesses in Canada still accept cash as a form of payment, the majority of transactions are being done with credit cards and debit cards. In fact, during the COVID-19 pandemic in the early days, there was even a number of businesses in Canada that refused to accept cash for a short period of time for fear that the cash had the virus attached to it. And also, most Canadians now enjoy the convenience of having online banking and being able to manage their personal finances from the comfort of their own home. So what it really comes down to is most Canadians keep their money in banks because it's safe, convenient, and sometimes required in the case of direct deposit from an employer. So we have basically seen the types of services that banks offer evolve over time based on the needs and wants of society and the technology that's available. Credit cards and debit cards are a fairly modern convenience. While credit cards saw their debut in the 1960s, they didn't really come into Canada and gain prominence until the late 70s and 80s. And it wasn't until even later that debit cards came around. They really didn't become popular until the late 80s and early 90s. And all these things that we now take for granted, the Interact system in Canada, the point of sale, being able to use your debit card to make purchases at a store, that is a relatively new invention in Canada. And online banking is one of the newest features of personal finance, having been introduced not that long ago. In fact, when online banking was first introduced, there was a huge number of people who were very wary because they were worried about the security of doing their banking online. But over time, people became more and more comfortable and more confident, and now there's a large number of people that do their banking right on their phone. So the Canadian banking system has evolved over time based on the needs in a changing world. But one of the things that has remained fairly constant is the fact that banks offer generally two types of accounts. Deposit accounts, those are accounts where we put money into the bank, and loan accounts, those are accounts where we borrow money from the bank.
Wake up!
Deposit accounts include any type of account that you put money into that maintains a positive balance, meaning that it has more than $0 in it. If the balance goes into a negative, then that turns into a loan account. Loan accounts are accounts where you borrow money from a bank, and you can generally look at it as if you have an account that has a negative balance that you're paying back. Let's take a look at a list of the basic accounts that most Canadian banks offer. On the deposit account side, we have checking and savings accounts. These are your standard bank accounts where your income gets deposited into, and perhaps you use your debit card to make payments, or you go to an ATM machine to withdraw cash, and most of the transactions in and out of your bank occur. Now, in the past, banks used to offer interest on these accounts, but with interest rates being historically low for such an extended period of time, a lot of banks have done away with interest on these basic accounts and just use them for transactional purposes. Next, we have term deposits, such as guaranteed investment certificates. These are accounts where you would deposit a certain amount of money into for a given amount of time, and you would earn some interest on that investment. Then we have the registered accounts, RRSPs, RESPs, and the tax-free savings account. RSP accounts are holding accounts registered with the Canadian government that were brought in to help people without pensions save for retirement. They have favorable tax implications associated with them, and any money deposited into the plan can be invested in a variety of different investments, and the income grows tax-free. Our ESPs, or Registered Education Savings Plans, are accounts that are generally opened by parents for their children's future educational needs. Parents can deposit into an RESP, and one of the advantages is that the Canadian government offers a grant for any contributions made to these accounts. The grant currently stands at 20% up to a specific amount, which means that if you deposit, say, $1,000 into one of these accounts, the government will give you a grant of $200 right off the bat. However, money withdrawn from these accounts must be used for educational purposes, otherwise the grant portion is forfeited and needs to be paid back. The tax-free savings account is a newer type of account. Introduced in 2009, it allows regular people, smaller investors, to open an account and invest in things like the stock market or bonds or GICs or mutual funds, and the income that they receive on those investments is not taxed. For many people, the TFSA account has replaced the RSP account as their investment account of choice. One thing to be aware of is all these registered accounts are just holding accounts. They're just a shell. Within these accounts is where people can purchase different investments. You'll sometimes hear people say things like, I'm going to invest in RSPs. And that's not really a correct thing to say. RSPs themselves are not an investment. They're just a registered holding account, and you would purchase various investments within that account.
Wake up!
And now we're moving on to loan accounts. The first type of loan account we're going to talk about is credit cards. Most adults these days in Canada have at least one credit card. And if you were looking to make online purchases or book things online or rent something, it's almost impossible to do these things without a credit card. So what is a credit card and how do they work? Well, a credit card is basically an account that allows you to borrow money for a short period of time to make purchases. Credit cards offer the cardholder access to a certain amount of credit up to a limit, called the credit limit, where they can make purchases and essentially borrow that money for a short period of time. Cardholders can borrow up to that credit limit at any time without having to reapply. This type of credit is called revolving credit because it can go up and down depending on when you make payments and when you make purchases. The credit card companies keep track of all the purchases you make, and at the end of each month send you a statement with a total at the bottom. And this is where the one huge benefit of credit cards comes into play. Credit card companies offer a grace period, usually 21 days from the date of the statement, that if the payment in full is made, the credit card holder will pay no interest on the purchases. So you are essentially able to borrow that money to make those purchases for a short amount of time without having to pay interest on it. You are able to access that short-term credit for free. On the flip side, however, if you don't pay off your credit card bill in full each month, then you will start accruing interest on the purchases you've made. And credit card interest can be quite high, sometimes as high as 20%. So credit cards can be an extremely useful way of tracking purchases and spending when going through the personal budgeting process. But if you get into a situation where you are not able to pay your balance off in full each month, you can be charged some hefty interest rates. Personal loans.
Wake up!
Now with a personal loan, you ask the bank to borrow a specific amount of money and then make arrangements to pay it back over a period of time with interest. The most common personal loans that people have are car loans. loans that they've gotten for the purchase of an automobile. And generally there'll be a principal amount, that's the amount that was borrowed, and then there'll be a set period of time that the loan needs to be paid back over. That's called the amortization. And then an interest rate will be charged on the balance owing at any given time. Now, mortgages are set up very similarly to loans in that they have a set payment, a set amount that you've borrowed, the principal, and an interest rate. One of the big differences, though, is because a mortgage is for a house, it's usually a much bigger loan, and so they stretch it over a much longer period of time, sometimes 25 to 30 years. And the interest rate gets renegotiated every few years. Generally, the interest rates on mortgages are much lower than personal loans because mortgages are secured by the property. If you are to not pay your mortgage payments, the bank can seize your property and then sell it in order to pay off the mortgage. Finally, we have a line of credit, also known as a revolving loan. These are very similar to credit cards in that you have a credit limit and you can borrow any amount up to that limit, and you can pay it up and down as you like. The credit is generally available at any time without the need to reapply. And usually, as long as you make the minimum payment, then the line of credit stays in good standing. However, with line of credit, the minimum payment is often just the interest that's owing, which means that if you don't make arrangements to make extra payments, the balance on your line of credit can just stay even, and you're just making the interest payment. So these are the main types of accounts that Canadian banks offer. Your average adult will have one or more of these accounts. There are other accounts available, but these are the most common ones that you come across when you go into one of Canada's banking institutions.